Joining me now is Sean O'Hara, president of Pacer ETFs. Sean, welcome to the show.
Good morning. Thanks for having me.
So what are you monitoring most closely during today's session?
Well, I mean, from day to day, the stories always change. I think the narrative that's currently running through the markets is that earnings growth is starting to accelerate. There's been some concern about valuations and that they were too high. And if we were, in a negative earnings cycle, that would be something to be concerned about. But you've seen tremendous productivity gains, and we had another pretty spectacular earnings rollout this past quarter. And then the estimates continue to go up to as much as 10 or 11% earnings growth. So I'd be looking for, in the day to day, which companies you think are those that are growing their earnings and which ones you think are struggling in this environment.
And I understand that you see this like going throughout the year and you see a year-end rally in the making for the markets. What else is fueling your optimism?
Well, I mean, I think there's a lot of things that were headwinds earlier this year. For example, the tariff talk, we had the Russia-Ukraine thing, we had potentially a rebound of inflation. We had some uncertainty around the tax bill and the quote-unquote big beautiful bill. Many of those things have started to have taken care of themselves, if you will. We got the big beautiful bill passed. That inflation's still a concern, but not as big a concern. The tariff impact has been muted and minimal. And then we had, the dual summits, if you will, between Putin in Alaska and the rest of the EU leaders and President Zelensky in Washington yesterday. So all those things that were sort of uncertainties are starting to become more and more clear. And in your previous interview, you talked about Fed policy. Jerome Powell's out at the big meeting this week. I expect that they will cut in this meeting. I think there's justification for that. I've said for a while now, I think they're a little bit behind the curve. I wouldn't expect them maybe to go 50 basis points, but I think if they don't cut 25, I think the market will be disappointed.
And, if those rate cuts do happen, what impact do you think this will have on market activity?
Well, I mean, I think the consumer has been the driver, although recently I've read stuff that said that the CapEx expenditures on AI and data centers are going to increase above consumer spending. So there's been a change in the lead of spending. But if you think about the effect of interest rates, it sort of trickles its way all the way through the economy. It helps potential home buyers. So I would be thinking about the home builders. I think it helps small cap stocks a little bit because they tend to be more highly leveraged. So, interest rates coming down is a critical part of what would need to be in place, I think, for the market to continue to go forward and rally perhaps in the fourth quarter.
And John, one of the topics arguably generating the most excitement across the markets is artificial intelligence. How do you think investors can take advantage of this?
Well, there's going to be about $7 trillion spent over the next 3 to 5 years on data center build out. So those commitments are sort of in place. So I think the way you play that is perhaps you buy the publicly traded data center names, those that specialize in the construction and maintenance of those centers. We have an ETF at Pacer SRVR server, so get the little pun there, that sort of owns all that critical, that mission critical infrastructure that's necessary for AI to become what it really is intended to be. And then we have another ETF, TRFK, that basically we just threw everything in the data center in the parking lot. So what really makes the data center work? And so that's chips, software, and things of that nature. And so I would be looking at those types of things going forward as I think this massive trend, and I think it's almost an unstoppable trend for this CapEx spending. I want to own the names that are going to benefit from that spending first, and then down the road, I think you want to look at the sectors that are going to be able to use AI in the most effective way, and that's perhaps healthcare. Stands out the most.
Now, Mag 7 stocks and other large caps, dominate the headlines. But do you think there are any more under the radar opportunities that investors are overlooking?
Yeah, I think though the issue with cap weighting is that those big stocks take up so much of the weight of the indexes. So you have a big percentage of the return is sort of tied to 7 names. We take a slightly different view here at Pacer on growth. We use free cash flow margin, which some of those Mag 7 stocks are massive free cash flow margin generators. And free cash flow margins, the free cash flow you generate divided by your sales. So it's just a measure of how effectively you can bring sales into excess free cash flow. We screen indexes for the 100 stocks with the highest free cash flow margin. So we own names like, for example, AppLovin or Palantir, which are at the smaller weights in these big indexes because the Mag 7 names try to crowd them out. And so the ticker there is CalG, which is actually keeping pace with the broad growth indexes and the NASDAQ 100, but it only has about 4% of the weight. It's like, the way I think about it is like an analogy. If you have a big family at dinner and all the adults are stealing all the food, the kids don't get the food to grow. And so that's the real issue with cap weighting. We tend to disconnect from that cap weighting and give bigger weights. Like, I think AppLovin is like a 10 basis point weight in the growth index. Well, if it doubles, you wouldn't even feel it. Whereas we give it like a 3% weight in our portfolio so that you can really feel the impact. And there's probably a half a dozen or a dozen names, below the radar, if you will, that are up as much, if not more than those Mag 7 names or NVIDIA year to date. So I think there's a tremendous opportunity for investors to sort of look down into these broad indexes and find names that are underweight because of the cap weighting scheme that are actually generating high free cash flow margins and profit from that by giving them a big reward.
Sean O'Hara, president of Pacer ETFs, thank you so much for joining us.
Thank you so much as well. Have a great day.
Thank you. Still to come.